Did you hear about the man who claimed his dog as a dependent on his tax return? He said it was because he guards his money just as much as he does. Now that's one way to make the tax man scratch his head. Today we're diving into the less furry but more practical side of finances, tax-saving strategies for investors. And don't worry, no canine dependents involved. While we don't suggest you claim your pet as a dependent, we do have some legitimate tax-saving tips for investors. Now, taxes on investments might seem like a nightmare, but they don't have to be. Let's unravel this tangled web together. At its core, taxes on investments usually come in two forms: capital gains tax and dividends. Imagine buying a piece of artwork, holding onto it while its value increases and then selling it for a profit. That profit is what we call a capital gain, and it's subject to capital gains tax. The rate of this tax can vary based on how long you've held the asset before selling it. On the other hand, dividends are a bit like a pat on the back from a company you've invested in. They're saying, "Great job for investing in us. Here's a little something for you." This little something is a dividend, and yes, you guessed it, it's also taxable. Understanding these taxes is not just about paying Uncle Sam his due, it's about strategizing, planning, and ultimately keeping more of your hard-earned money in your pocket. So understanding these taxes is your first step towards saving on them. Think of tax-efficient investment vehicles as your financial superheroes, saving your day from the tax villain. Let's dive into the world of these superheroes. First on our roster is the Roth Individual Retirement Account, or Roth IRA, a special type of retirement account you fund with post-tax income. The superpower of a Roth IRA? You can withdraw the funds tax-free after you retire. It's like planting a seed with today's taxed income and reaping the benefits of a full-grown tax-free tree during your retirement years. Next up, we have the formidable 401(k). This workplace retirement savings plan allows you to save a piece of your pre-tax salary, reducing your taxable income for the year. It's like having a cloak of invisibility against taxes. And the cherry on top? Many employers match a portion of your contributions, adding a nice boost to your savings. But here's the kicker. Both Roth IRAs and 401(k)s have annual contribution limits, so it's important to plan accordingly. Remember, even superheroes have their limitations. Let's not forget about index funds, the silent but potent heroes of the investment world. Index funds are mutual funds or exchange-traded funds designed to follow certain preset rules so that the fund can track a specified basket of underlying investments. They're known for their low turnover rates, meaning they don't trade frequently. This lack of frequent trading results in fewer taxable events, making index funds a tax-efficient choice. And finally, we have the Health Savings Account, or HSA. This secret weapon allows you to make pre-tax contributions, grow your money tax-free, and even withdraw it tax-free for qualified medical expenses. It's a triple tax advantage. Remember, your goal is to maximize your investments while minimizing your taxes. Each of these investment vehicles has its own strengths and weaknesses, and it's up to you to assemble your financial superhero team wisely. Choosing the right investment vehicle can be a game changer in your tax-saving journey. Investments should not only grow your wealth, but also save your taxes. Let's see how. Starting off, remember that time is a friend of your investments. Holding on to your investments for at least a year can significantly lower your capital gains tax. It's the tortoise and the hare story. Slow and steady often wins the race. So it's not just about buying low and selling high, it's also about when you sell. Hold your investments for a year or more and you transition from short-term capital gains, which are taxed as ordinary income, to long-term capital gains, which have more favorable tax rates. But what if you're feeling philanthropic? Donating stocks to charity is a win-win. You not only get to support a cause you believe in, but you also get to avoid paying capital gains tax on the appreciated stocks. Plus, you can take a tax deduction for the full fair market value of the donated stocks. It's like having your cake and eating it too, but in this case, the cake is your stock portfolio and the icing is the tax savings. Then there's tax loss harvesting, a slightly complicated yet rewarding strategy. This involves selling off investments that have suffered a loss to offset the gains from other investments. The silver lining of a bad investment, if you will. It's like using a coupon at your favorite store. You're still spending money, but you're saving a bit on the side. And let's not forget about tax-efficient funds. These are designed to minimize tax liability through strategies such as minimizing turnover, and focusing on stocks that qualify for lower tax rates. It's like going on a diet, but for your investments, cutting out the high-tax calories and focusing on the low-tax nutrients. Remember, a smart investor not only makes money but also saves money on taxes. So let your investments work for you, not just in generating wealth but also in saving on taxes. Now that's a smart investment strategy. So let's do a quick recap of our tax-saving strategies. Firstly, we took a deep dive into understanding taxes on investments. We learned that it's not just about how much you earn, but how much you get to keep after taxes. Remember, the tax man is always lurking around the corner, so it's crucial to understand the ins and outs of investment taxes. Moving on, we explored tax-efficient investment vehicles. These are your knights in shining armor ready to defend your earnings from the tax dragon. We discussed options like tax-efficient mutual funds, exchange-traded funds, and even the humble yet mighty individual retirement account. These vehicles are designed to minimize your tax liability and maximize your earnings. Let's not forget the power of tax-free growth and compounding. It's like magic, but for your bank account. Lastly, we delved into smart investment strategies. These aren't just about picking the right stocks, bonds, or real estate. It's about the timing of your investments, holding periods, and even considering the impact of capital gains tax. Remember, with great power comes great tax responsibility. With these strategies in your arsenal, you're well equipped to conquer the tax season. If you found this video helpful, don't forget to hit the like button and subscribe for more financial advice. Remember, the tax man cometh, but you have the power to decide how much he taketh.